The Reserve Bank of New Zealand cuts by 50 basis points, with markets pricing another outsized move in November. Attention turns to US inflation data after last week's strong jobs report, and the Reserve Bank of India holds, but moves to a neutral stance. That's coming up in our 5 Things in 5 minutes, and then in our bonus deep dive interview, as China's Finance Ministry announces a new stimulus briefing for Saturday, ANZ Chief Economist for Greater China Raymond Yeung analyses the growth prospects for China's economy.
We do not think that the stimulus package will fix the structural weaknesses, but any counter-cyclical policy will just be borrowing the future.
But first in 5 and 5 with ANZ. I'm Alex Tarrant, standing in for Bernard Hickey, who's on family leave. The Reserve Bank of New Zealand has cut its official cash rate 50 basis points to 4.75%. That was in line with market expectations. ANZ New Zealand Chief Economist Sharon Zollner says the move was based on increased confidence that inflation is on its way back to the middle of the RBNZ's 1 to 3% target band.
So it certainly was not a hawkish document, but they clearly seriously discussed going 25 or 50. It wasn't an obvious decision, but at the end of the day, they do have more confidence that inflation is falling as they require it to in the near term, and that it's going to stay where it needs to be in the medium term. So they acknowledge that not only has the economy evolved much as expected, but that the outlook is still much the same as in August. So as we said in our preview, it's not that the data has challenged the Reserve Bank's forecast. They're not going to be revising down their forecasts of either growth or inflation. Rather, it's that their confidence in those forecasts has grown.
Off the back of that, and a 0.3% rise in the US dollar index overnight, the Kiwi was down 1.25% at 60.61 US cents at 4 a.m. Sydney-Melbourne time. The Aussie dollar was down 0.4% at 67.18 US cents. Number 2. New Zealand's latest inflation print was 3.3% in the June quarter, with September figures out next week. Sharon says high-frequency data gave the RBNZ that confidence that price growth is slowing.
The single most important piece of data was the NZIER's quarterly survey of business opinion, which showed a sharp drop in pricing intentions and also clear signs of lots of spare capacity in the economy, particularly in the labour market. There are some data prints that have gone the other way. GDP, while very weak, was actually stronger than the Reserve Bank was expecting, and we've seen a vigorous response in business confidence and activity expectations in our survey. But the Reserve Bank didn't talk about that. They also didn't mention the fact that the early indicators for the housing market have picked up very strongly, because at the moment prices are still going backwards. And indeed, they commented that a weak housing market is expected to continue to be a dampener on growth for some time. So that might be one area of potential upside risk to their growth forecasts.
Number 3. All eyes are now on whether the 50 basis point cut will be followed by another in November. The Reserve Bank's next decision after that will be in February.
We've still got a 50 basis point cut penciled in for November, but I say penciled in because we have 2 very important pieces of data between now and then. We have CPI inflation next week. It's clear that inflation is going to fall well into the target band, but we are anticipating a very small but nonetheless upside surprise to the Reserve Bank's estimate of non-tradable inflation. Now, there's a series of those over the last 18 months, and that it's fair to say that non-tradable inflation is nowhere near as low as the Reserve Bank thought it was going to be by now when they called a halt to hikes back in May last year. And we've also got labour market data, unemployment and employment. That data's out in early November, 3 weeks before the Reserve Bank decision.
Number 4. In global markets, the S&P 500 hit a fresh record high as investors turn their attention to the US Fed's inflation mandate. ANZ head of G3 Economics Brian Martin says September CPI tonight is expected to have risen 0.1%.
That would leave the annual rate of headline inflation at 2.3%, down from 2.5%, according to the consensus. However, core inflation is expected to be a bit firmer. The market is looking for a rise of 0.2% in the month, and for the annual rate to remain steady at 3.2%. The 3.2% core inflation print, alongside the strength we're seeing in labour markets, does to us suggest that the FOMC should proceed gradually in coming months with rate cuts. Of particular interest within the CPI data will be what's going on with shelter inflation and what's going on with supercore inflation. In August, shelter inflation rose 0.5% in the month and supercore inflation rose 0.33% in the month.
Number 5. The Reserve Bank of India also had a rate decision yesterday, opting to hold at 6.5%. ANZ economist Diraj Nim says the RBI downgraded its hawkish stance to neutral, paving the way for a December rate cut.
The monetary policy report that accompanies the monetary policy statement today sort of reflected that starting from the third quarter of 2025, inflation will show signs of alignment with the 4% target, something that they've been after for so long. So I think the fact that inflation is seen gradually falling towards the target in their forecast horizon is something that may have, spurred them to shift to a neutral stance.
Diraj Nim there. Now, in our bonus deep dive interview, the impact of China's stimulus briefing this week continues to reverberate. The Finance Ministry overnight announced it would hold a new stimulus briefing on Saturday. Here's ANZ Chief Economist for Greater China Raymond Yeung on the outlook for the Chinese economy following the Golden Week holiday.
As far as the official release provided is that this year domestic travel, the trips by domestic residents increased by 4%, and it's quite vibrant, in terms of the activities, in terms of consumption, and also the monetary policy easings and the mortgage interest rate cut seems to have some effect on property sales, and there are many different reports locally about the increase in property sales in the last few days. Now, obviously, this type of rebound is reasonable because of the sentiment improvement in the stock market, as well as the pledges by the top policymakers want the property price to stop falling. So that has some impact on property sales and the buying appetite by household, making use of the holidays, go back to the hometowns and to buy property. But the main question is how long this type of rebound will sustain, and without a major change and major shift in housing policy, it still seems to me that any type of rebound in property sales will just be short-lived.
And I see the World Bank has downgraded its forecasts for China growth.
We keep our GDP forecast for this year as 4.9%, and we believe that the more supportive measures will be launched over the next 2 or 3 months. Also, the PMI, official manufacturing PIR number released last week, surprised on the upside. So based on our model, we see that with 0.2 or 0.3 percentage point of support by the government stimulus, we'll be able to help achieve 4.9% growth, matching our forecast. We downgrade the GDP forecast next year to 4.3% and 4.0% for 2026 as well, because we do not think that the stimulus package will fix the structural weaknesses, but any counter-cyclical policy will just be a kind of borrowing the future, which means that some of the activities that should be happening next year will probably be front-loaded this year. So the fourth quarter number will still be able to achieve 4.8%, so that the full will match 4.9% growth forecast. But next year, the economic environment will be more severe, especially with the external risk, including the trade tension with the US and Europe as well.
Raymond Yeung there. I'm Alex Tarrant, standing in for Bernard Hickey, who is away on family leave. That was 5 and 5 with ANZ for Thursday, October the 10th. Catch you tomorrow with analysis of that US inflation data.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.